In 2005, I was 59 years old. I had built Oaktree Capital into one of the most successful distressed debt firms in the world. Our assets under management had grown from nothing in 1995 to over $40 billion. By any measure, I was successful, wealthy, accomplished, and I was about to make a decision that would have cost me and our investors hundreds of millions of dollars. The real estate market was boiling, credit was flowing like water, every investment bank was pushing commercial mortgage-backed securities. The returns looked extraordinary. Our competitors were loading up. Some of our own portfolio managers were advocating that we do the same. I had the analysis, I had the projections, I had a team telling me we were missing out on easy money. And for about 6 months, I seriously considered it. What stopped me wasn't brilliance. It wasn't superior information. It was a principle I'd learned 30 years earlier, watching the Nifty 50 bubble burst when I was at Citicorp. A principle that whispered, when everyone is doing something because it's working, that's precisely when it becomes most dangerous. We passed, we sat on cash, we looked foolish through 2006 and early 2007. Then 2008 happened, and that cash, that stupid decision to wait, allowed us to raise $11 billion for distressed opportunities when assets were trading at 30 cents on the dollar. That principle has made me more money than any brilliant insight ever has. Now I'm 78 years old. I've been investing for over 5 decades. I've survived 9 major market crises. I've made mistakes that cost millions and decisions that made hundreds of millions. And if I could sit down with my 60-year-old self, or with you, if you're in that stage of life now, there are things I wish someone had told me with absolute clarity. Not about stock picks, not about asset allocation percentages, but about the fundamental shift in thinking that needs to happen after 60. Because the rules change, the game changes, and most people don't realize it until it's too late. Before I continue, I need to know who I'm talking to. Drop your age in the comments, just the number. I want to see how many people in this stage of life are paying attention to what actually matters now. And if you're serious about protecting what you've built while still growing it intelligently, subscribe now. This channel isn't about chasing returns or finding the next hot investment. It's about second-level thinking, the kind of thinking that's protected wealth through multiple market cycles, multiple crises, and the inevitable mistakes we all make. The professionals who manage serious money think this way. Now you will too. Here's what I'm going to show you in the next several minutes. The 5 critical insights I wish I'd fully understood at 60. Each one builds on the last. Each one contradicts something you've probably been told. And the final one, the one I'll get to near the end, is the insight that most people never learn until it's too late to implement it properly. Let me start with what most people get wrong about this stage of life. They think being over 60 means becoming conservative, shifting everything to bonds, playing it safe, protecting what you have by avoiding risk entirely. Every financial advisor with a computer program tells them this. It's baked into target date funds. It's the conventional wisdom. Your age should equal your bond allocation. If you're 65, you should have 65% in bonds. But here's what 5 decades of watching actual outcomes shows. The people who followed that advice religiously often ran out of money. Not because they took too much risk, but because they took too little. Because they confused volatility with risk. Because they prepared for the wrong danger. This isn't opinion. This is pattern recognition across multiple generations of retirees, multiple interest rate environments, and multiple inflation regimes. And it all comes down to understanding what risk actually means at this stage, not market fluctuations, not portfolio volatility, but the risk of your money not lasting as long as you do. I'm going to break this down into 5 insights. Each one builds on the last. Miss one and you'll make decisions that feel safe, but create real danger. Understand all 5, and you'll navigate this stage with clarity that most people never achieve. Let's start with the insight that changes everything else. The first thing I wish someone had told me at 60 is this. Your time horizon is longer than you think. And planning for too short a horizon is more dangerous than market volatility. This is counterintuitive. At 60, you feel like you're approaching the end of your investing life. You've heard the advice, get conservative, reduce risk, protect what you have. It feels prudent, but it's often wrong. And here's why. If you're 60 and in reasonable health, you likely have 25 to 30 years ahead of you. Your spouse might have even longer. That's not a short time horizon. That's longer than most people's entire accumulation phase. Here's what most people do. They shift dramatically toward bonds and cash equivalents at 60 or 65. They believe they're reducing risk. They feel safer watching their account balance stay stable. But they're actually increasing their real risk. The risk that inflation erodes their purchasing power over 3 decades. The risk that their money doesn't grow enough to fund their actual lifespan. The risk that they'll be 85, still alive, and running out of money. I see this constantly. In 2010, I watched retirees pile into bonds yielding 3% to 4%, thinking they were being prudent. Over the next decade, inflation averaged around 2%. Their real return was barely positive. Meanwhile, their expenses, healthcare, housing, the things retirees actually spend money on, increased faster than general inflation. They felt safe, but they were slowly getting poorer in real terms. Let me show you this principle in action. In 2000, a 60-year-old retiree with $500,000 had a choice. Option A, put 70% in bonds yielding 6%, keep 30% in diversified stocks, very conservative. Option B, keep 50% in stocks, 50% in bonds, more volatile, but more growth potential. Over the next 20 years, through the dot-com crash, the financial crisis, and COVID, Option B, despite higher volatility, ended up with roughly 40% more wealth in inflation-adjusted terms. Not because they got lucky, because they maintained enough growth assets to offset inflation over a 20-year period. The investors who went too conservative felt safer in the short term, but by age 80 they had significantly less purchasing power. Some were running out of money. This wasn't luck. This was understanding that time horizon and real risk work differently than conventional wisdom suggests. At Oaktree, we've always focused on what we call loss of purchasing power risk, rather than just volatility risk. When we advise endowments and foundations, institutions that need to exist forever, we don't tell them to avoid stocks because they're volatile. We help them understand that the real risk is not having enough growth to maintain their mission over decades. Your retirement is the same. You're not managing money for next year. You're managing it for potentially 3 decades. Now here's the second-level thinking. First-level thinking says, I'm 60, so I need to be conservative with my money. Second-level thinking asks, conservative for what purpose? Conservative against which risk? And when you ask that question, you realize that being too conservative against short-term volatility can make you dangerously exposed to long-term purchasing power erosion. This is what separates people who maintain their lifestyle through retirement from people who progressively restrict their lives as they age. Not intelligence, not luck. Thinking process. So what do you actually do? You maintain enough growth assets to offset inflation over your actual time horizon. For most people over 60, that means keeping 40% to 60% in stocks or stock-like investments, not 20% to 30%. You diversify those stocks globally. You rebalance systematically. You don't panic during downturns. This isn't complicated, but it requires accepting short-term volatility to avoid long-term erosion. Most people can't do that. They feel the pain of a 20% market drop more than they feel the slow erosion of 2% annual inflation over 20 years. You can start reassessing this today. Look at your current allocation. Ask yourself, am I positioned for my actual time horizon or for the time horizon that feels emotionally comfortable? But maintaining growth assets alone isn't enough, because there's a specific period where this strategy can destroy you if you're not careful. Which brings us to the second insight. The second thing I wish someone had told me at 60 is this. The first 5 to 7 years of retirement are the most dangerous period of your financial life, and sequence of returns risk can destroy even a well-planned retirement. This is the insight most people never learn until it's too late. It's not about how much you have. It's about when you experience losses relative to when you're taking withdrawals. Here's what most people do. They retire with a nest egg, start taking withdrawals, and assume that if their average return over 30 years is 7%, they'll be fine. They've been taught that markets average 7% to 10% over time, so their plan should work. But averages lie, and in retirement, sequence matters more than average. Let me show you why. Take 2 retirees, both with $1 million, both withdrawing $50,000 per year, adjusted for inflation. Both experience the exact same returns over 30 years, just in different order. Retiree A experiences good returns early, bad returns later. Retiree B experiences bad returns early, good returns later. Same average return, same withdrawal rate. Completely different outcomes. Retiree A ends up with money left over. Retiree B runs out of money by year 23. Same average return, different sequence, devastating difference. This happened in real life, and retirees who started taking withdrawals in 1999 or 2000, right before the dot-com crash, had a much harder time than retirees who started in 2003 or 2004 after markets had already fallen. Not because they made different decisions, because they experienced losses at different points in their withdrawal phase. I watched this destroy people in 2008. They'd retired in 2007 with what seemed like plenty of money. Then markets dropped 50%. They were taking withdrawals from a declining portfolio. By 2010, they'd locked in losses and depleted their accounts far more than they'd planned. Many never recovered. The investors who understood sequence risk had positioned differently. They had several years of expenses in stable assets. When markets crashed, they didn't have to sell stocks at the bottom. They lived off their stable assets, let their stocks recover, and eventually replenished their cash reserves when valuations normalized. This wasn't luck. This was understanding that the first 5 to 7 years of retirement require a different strategy than the accumulation phase. At Oaktree, we've always maintained what we call dry powder, capital ready to deploy when opportunities arise. For retirees, the equivalent is having enough stable assets to cover 3 to 5 years of expenses. This isn't being conservative. This is being strategic about sequence risk. Now here's the second-level insight. First-level thinking says, I need X% annual return to make my retirement work. Second-level thinking asks, how do I protect myself from experiencing large losses during the years when I'm taking withdrawals? And when you ask that question, you realize you need a bucketing strategy. Near-term expenses in stable assets, medium-term in balanced investments, long-term in growth assets. You're not trying to maximize return. You're trying to minimize the chance that a bad sequence destroys your plan. So what do you actually do? You keep 2 to 4 years of expenses in cash or short-term bonds. You keep another 3 to 5 years in a balanced portfolio. The rest, money you won't touch for 7+ years, can be in growth assets. When markets are up, you replenish your near-term buckets. When markets are down, you live off the stable assets and leave growth assets alone to recover. This requires discipline. It requires not panicking when your growth bucket drops 30%. But it's the difference between running out of money at 80 and maintaining your lifestyle through your entire retirement. Consider the data on this carefully. Look at your withdrawal rate relative to your time horizon. Stress test what happens if you experience 2008 level losses in your first 3 years of retirement. But even with the right time horizon and sequence risk protection, there's a psychological trap that destroys more retirements than market crashes, which leads to the third insight. The third thing I wish someone had told me at 60 is this. Your biggest enemy isn't market crashes. It's your own behavior during market crashes. And the decisions you make when you're most afraid are usually the most destructive. This is the hardest truth to accept. We like to think we're rational. We believe we'll stay disciplined. We tell ourselves we understand that markets fluctuate. Then markets drop 30% in 3 weeks like they did in March 2020. And suddenly all that rational planning disappears, fear takes over, and we do exactly the wrong thing at exactly the wrong time. Here's what most people do. They maintain their strategy during good times. They feel smart when markets are rising. Then a crisis hits. They watch their account balance drop by hundreds of thousands of dollars. The news is apocalyptic. Everyone is panicking, and they sell, locking in losses, telling themselves they'll get back in when things stabilize. But things never feel stable at the bottom. By the time things feel safe enough to reinvest, markets have already recovered 30% to 40%. They've locked in the losses and missed the recovery. I see this every single crisis. In 2008, in March 2020, in every major downturn. The investors who destroyed their retirements weren't the ones who had bad plans. They were the ones who abandoned good plans at the worst possible moment. Let me show you the data. A study of actual investor behavior during the 2008 to 2009 crisis found that investors who sold stocks in late 2008 or early 2009 took an average of 5 years to get back into the market. By that time, stocks had more than doubled from the lows. These investors locked in losses of 40% to 50% and missed gains of 100% plus. A $1 million portfolio that rode through the crisis recovered to about $1.3 million by 2013. A $1 million portfolio that sold at the bottom and stayed in cash until 2014 was worth about $650,000. Same starting point, different behavior, devastating difference. The investors who maintained discipline, who had positioned for sequence risk with proper buckets, who understood their time horizon, they recovered fully and continued their retirement plans. The ones who panicked destroyed years or decades of careful planning in a few emotional weeks. This isn't about being smarter. This is about having a framework that prevents you from making emotional decisions when you're most afraid. In my own career, I've made mistakes. But the biggest mistakes were never analytical errors. They were times when I let fear or greed override my process. In 1990, during the junk bond crisis, I was managing high-yield bonds at TCW. The market was collapsing. Clients were redeeming. I felt intense pressure to sell and protect what was left. But I'd learned to ask, is the fundamental value still there, or has only the price changed? The fundamentals were intact. The price had collapsed due to forced selling and panic. We held. We bought more when we could. Within 18 months, the portfolio had recovered and then exceeded previous highs. That experience taught me that your process matters most when following it feels hardest. Now here's the second-level thinking. First-level thinking says, the market is crashing, I need to protect myself by selling. Second-level thinking asks, am I responding to actual changes in fundamental value, or am I responding to price changes driven by emotion? And when you ask that question, you realize that most market crashes are opportunities to stay disciplined, not reasons to abandon your strategy. So what do you actually do? You create what I call commitment devices. You write down your strategy when you're calm and rational. You define in advance what would cause you to change course. Specific fundamental criteria, not price drops. You review this document during crises. You have someone, a spouse, an advisor, a trusted friend, who knows your plan and can remind you of it when you're emotional. This isn't complicated, but it requires humility about your own psychology. Most people believe they'll stay rational during a crisis. Experience shows they won't unless they've prepared specific mechanisms to prevent emotional decisions. Start this now. Write down your current strategy. Define what would actually justify changing it. Make it specific and fundamental, not price-based. The data tells us something important about behavior and outcomes. The correlation between staying disciplined and long-term success is stronger than the correlation between starting wealth and long-term success. Discipline beats resources when time horizons are long, but even perfect discipline and positioning won't help if you're making one critical mistake about how you think about your wealth at this stage, which brings us to the fourth insight. This is where conventional wisdom fails most completely. The fourth thing I wish someone had told me at 60 is this. You're not managing a portfolio anymore. You're managing a personal endowment, and that requires a completely different framework. This reframe changes everything. Most people think about their retirement savings as a pile of money they're gradually spending down. They watch the balance. They worry about it shrinking. They make decisions based on preserving the nominal amount. But that's the wrong mental model. You're not managing a spending account. You're managing an endowment that needs to generate income for potentially 30 years while maintaining purchasing power. Here's what most people do. They focus on their account balance. When it's up, they feel good. When it's down, they panic. They think about their wealth as a number that should stay stable or grow. But that's first-level thinking. Second-level thinking asks, what's the real purpose of this capital? What does it need to accomplish? How do I structure it to achieve that purpose reliably? And when you ask that question, you realize you need to think like an endowment manager, not like someone with a savings account. Consider how major university endowments operate. Yale's endowment doesn't try to preserve its nominal value. It tries to generate reliable distributions while maintaining purchasing power over centuries. It diversifies across asset classes. It maintains spending discipline. It thinks in decades, not years. Your retirement should work the same way. You need reliable distributions, your living expenses, you need to maintain purchasing power against inflation, you need to survive multiple market cycles. You're managing a personal endowment, not a bank account. The evidence for this approach is overwhelming. Retirees who adopt an endowment mentality focusing on sustainable distribution rates, diversification, and long-term purchasing power, maintain their lifestyles more successfully than retirees who focus on account balance preservation. At Oaktree, we manage capital for endowments and foundations. We don't promise them their account will never decline. We help them structure for sustainable distributions through all market environments. The same principles apply to retirement. In 2008, Yale's endowment dropped about 25%, but they didn't panic. They maintained their spending policy with minor adjustments. They rebalanced into distressed assets. By 2014, they'd fully recovered and exceeded previous highs. They thought like an endowment, not like a panicked investor watching their balance. Now here's the critical insight. First-level thinking says, my portfolio is worth X, and I need it to stay at X or grow. Second-level thinking says, my portfolio needs to generate Y per year in real terms for Z years. How do I structure it to do that reliably? This shift in thinking changes how you make every decision. You stop obsessing about short-term balance fluctuations. You start focusing on sustainable distribution rates, diversification, and maintaining purchasing power. So what do you actually do? You calculate your sustainable distribution rate, generally 3% to 4% of your portfolio value, adjusted annually for inflation. You diversify across multiple asset classes, not just stocks and bonds. You rebalance systematically. You think about your wealth as a machine that generates income, not a pile of money you're spending down. This requires a different mindset. Most people can't make this shift. They're too attached to watching their balance, too reactive to short-term movements. But it's the difference between managing your retirement successfully and constantly worrying about running out of money. Review your current approach. Are you thinking like an endowment manager or like someone with a savings account? The distinction matters more than almost anything else. This leads to the final insight, the one that took me longest to fully understand. The one that, if I could go back to age 60, I would emphasize above everything else. The fifth thing I wish someone had told me at 60 is this: the greatest risk you face isn't financial. It's running out of purpose before you run out of money, and how you think about wealth at this stage determines whether your later years are fulfilling or empty. This is the insight most people never learn until it's too late to do anything about it. They spend their entire lives accumulating. They focus on the number. They reach retirement with enough money, and then they discover that having enough money without having enough purpose is its own kind of poverty. I've watched this happen to successful people repeatedly. They retire wealthy, they have everything they need financially, and within 2 years they're depressed, aimless, wondering what the point was. Here's what most people do. They spend their accumulation years focused entirely on the financial number. They sacrifice relationships, health, interests, and purpose for wealth accumulation. They tell themselves they'll enjoy life after retirement. Then they retire and they discover they've built a fortune but forgotten how to live. The money is there. The purpose isn't. And money without purpose doesn't produce fulfillment. I've been fortunate. I never fully retired. I reduced my role at Oaktree, but I continued writing memos, teaching, mentoring younger investors. I maintained purpose alongside wealth. But I've watched peers who retired completely, who had more money than they could ever spend, become hollow versions of themselves within a few years. This isn't about money. This is about what wealth is actually for. The evidence on this is clear from multiple studies of retirement satisfaction. Financial security is necessary but not sufficient for fulfilling retirement. People who maintain purpose, contribution, learning, and growth report significantly higher life satisfaction than people who simply consume their wealth. At this stage of life, the question isn't, do I have enough money? The question is, what am I using this money to enable? If the answer is just not working, that's not enough. If the answer is pursuing things that matter to me, contributing to things I care about, continuing to grow and learn, then the money serves a real purpose. Now here's the deepest insight. First-level thinking says, I need to manage my money carefully so I don't run out. Second-level thinking asks, what kind of life am I funding with this money? And is that life worth living? And when you ask that question, you realize that financial planning without life planning is pointless. You can have a perfect portfolio and an empty life. You can manage sequence risk perfectly and still waste your remaining years. So what do you actually do? You spend as much time planning what you're retiring to as you spend planning your finances. You identify what gives you purpose. You maintain activities that create meaning. You invest in relationships, learning, contribution, growth. You use your wealth to enable a life worth living, not just to fund existence. This isn't complicated, but most people never do it. They focus entirely on the financial mechanics and ignore the purpose question until they're already retired and lost. Start this now. Write down what would make the next 20 to 30 years meaningful. What would you want to look back on? What would make you feel like this stage of life mattered? Then structure your finances to enable that life, not the other way around. That's where we started, me at 59, facing a decision that felt financially compelling but violated a principle I'd learned decades earlier. Now you understand what I've learned in the 19 years since. Being over 60 isn't about becoming conservative. It's about becoming strategic. It's about understanding your real-time horizon, protecting against sequence risk, managing your own psychology, thinking like an endowment, and maintaining purpose alongside wealth. I've spent 5 decades learning this. I've made mistakes. I've watched market cycles destroy some people and create opportunities for others. And I've distilled it down to these 5 insights. You now know what took me decades to fully understand. You have time to implement it. The question is, will you? Because here's the reality. Most people will read this, nod along, and change nothing. They'll go back to checking their account balance daily. They'll panic during the next downturn. They'll focus on the money and forget about the purpose. Don't be most people. Before you close this, write down one specific action you're going to take in the next week based on what you've learned here. Just one. Write it in the comments for accountability. Public commitment increases follow-through. And subscribe if you haven't already. Because this is about more than money. This is about thinking clearly during the stage of life when clear thinking matters most. This is about making decisions based on principles, not emotions. This is about using wealth to enable a life worth living. Over 50 years of investing teaches you this. The market will do what it does. You can't control that. But you can control your process, your discipline, your thinking. You can control whether you make decisions based on fear or based on principles. Being over 60 with financial resources is a privilege, but only if you use it wisely, only if you think clearly, only if you remember that the purpose of wealth is enabling a life worth living, not just accumulating a number. I can't implement this for you. I can only show you what I've learned. The rest is up to you.